Hello and welcome back to Blytheway Business News. Today we've got Amur Minerals and I'm joined by Adam Habib, who's an advisor to the board. Adam, welcome back to the show. Now, you've just announced an investment in the Nathan River Resources asset in Australia. Can you give us some background on that investment, please?
Yeah, of course, Tim. Great to be back online again with you as always. So obviously it's a very exciting transaction for us. We started work on this in earnest, I guess, beginning of March, with Glencore looking at the transaction, seeing how best to structure it, and to try and obviously maximize the opportunity for Amur. It took us, obviously, you can see, just under 6 months to conclude the transaction. And obviously, COVID-19 didn't help, particularly in terms of us carrying out due diligence and making things happen while we were going through the paperwork. But yes, the opportunity is phenomenal, and I think it's a great step for Amur, for its business.
Well, we'll come back to the step in a moment because it's not in Russia, it's not in nickel, it's iron ore in Australia. But the Roper Bar iron ore project, from what I've seen, it looks absolutely enormous.
Yeah, so the opportunity is great, and I think the Nathan River Resources management team have done a great job in breaking it down into 2 stages. So the first stage is to target and sell the easy and high value asset that's lying in the ground already, in the open pit, available to ship. So we've got about 4 million tons of high grade DSO, and
DSO, just for the viewers, that's
direct shipping ore. Yeah, exactly. Yeah. So this is the best stuff. This is what everyone's looking for when it comes to iron ore, and it produces a lump product which is particularly good in furnaces, and that means that we get a premium payment for that ore when it's sold in China. Now, the 4 million tons will be mined over the first 2.5-3 years, and during that time we will build a dense media separation plant, so we can increase the production. And then beyond that, obviously, we'll target that larger 446 million tons of iron ore as phase 2. And then if we get to phase 2 in 3 years, which we hope to, then, we're producing 4 to 5 million tons of iron ore per annum. And that is really a very significant operation.
I was going to ask you what the rationale for the move was, but I guess in a nutshell, that's it. But just again, you've gone from being a sort of a pure play nickel mining company in Russia to now opening up iron ore in Australia. Is the rationale all about access to quick and early revenues?
Well, I think it's 2 things. Firstly, obviously, our shareholders have been diluted for 13 years. So we had to stop that happening. We needed revenue. We needed to grow up as a business. Also, when we're spending those shares, i.e. issuing shares to get capital, it had to have some significant long-term upside. And we wanted to diversify outside of Russia because we want to appeal to the mutual funds, pension funds, and insurance companies to become stakeholders in Amur in the long run. So for us to get our nickel asset into production, we're going to need circa $500 to $700 million. And that means we're going to need $250 million at least of equity. And the great thing with NRR is if it comes through and we get into phase 2, there's a chance that a fair chunk of that will come from NRR as dividends to us. So we're going to need less money from external investors. And obviously that attractive cash flow will hopefully drive mutual fund and institutional investors into our shareholding, and we'll have a long-term stable investor base. And that's what we really need.
I like that expression. It's growing up as a company as you move into production and then find alternate ways to fund the nickel project. Right? So it's a lovely way of looking at it. We talked about growing up as a company. Grown-ups, they don't get much more grown-up than Glencore, the world's second biggest commodity business. I mean, how on earth did Amur, with respect, how on earth did Amur come to be involved with Glencore?
Okay, well, I mean, obviously, we're not directly involved. Glencore's obviously involved with Nathan River Resources in this transaction, and I guess there are a couple of key points in regards to that. The first thing is the port that Nathan River Resources is using is the Bing Bong port, which is a lovely Aussie name, and obviously it's Glencore who are the owners. So it was quite logical that Nathan River Resources would have to have a dialogue with Glencore. So I think that that's where kind of the genesis of this came through, and obviously in the process, I guess the relationships that we have across the market, we were pleased that Glencore called us and we got involved with the deal and worked with Glencore, as I said, since March to get this done. So yes, it's about relationships, I guess. That's how we got there. Yeah.
Excellent. Now, the last couple of years in the mining world, we've all got very excited about battery metals and EVs and nickel, which you have, and lithium and all the other things. But here we are going back to bulks, back to iron ore. But I did a bit of research before we went on air. Iron ore is currently at its highest price in 6.5 years. So your timing looks great. But tell us a bit, what's driving that increase in iron ore prices?
Okay, so I think there are two or three key fundamentals. The first one is global government stimulus. So the Chinese government, and in fact, most governments are now suffering. Their economies are suffering due to COVID-19, as we've seen in the UK as well. And they need to do something to increase employment, to drive their economies forward. Construction is one of the most logical things for these governments to do. It's something that they will not only drive revenues immediately, employ people, but in the long run it improves the competitiveness of their country. So there's a big drive by China, by the US, and by other countries to increase infrastructure spending. That is the demand for steel and hence the demand for iron ore. So we see a medium-term to long-term structural support from the COVID-19 pandemic for the iron ore price. Now, it won't stay at 126, 127, throughout. We think, or at least my view is over the next 9 months, it'll start drifting down. And that'll be post the second wave of COVID-19 that we're all about to enter into, unfortunately.
But nevertheless, I mean, China, I see, has now just struck a record level for importing iron ore, and China's accounting for what, something like half of the world's steel production. And it's
Yeah.
a bit of a stretch to say you're on the doorstep from the Northern Territories exporting into China, who's just, record this record level of iron ore imports. You are very well placed for servicing the Chinese market, I guess.
Yeah, no, absolutely. And I mean, and the great thing, if you compare shipping costs from Brazil, you're looking at 24 to 25 US dollars per ton. If you're looking at, Northern Australia, you're down at the $8 to $10 per ton. So your competitive advantage is immediately there. And obviously the time to shipment too, so you can deliver your goods to market quickly as well. You cut off the number of days, you need less working capital. All of these things are very, very positive for the particular location that NRR has in Northern Territories. So yes, it's definitely right position, right timing, right asset class, diversification, and hopefully we get some interest from these more strategic long-term shareholders. That's why we're doing this, as well as rewarding our current shareholders with something that means that we're not going to be diluting them going forward. We have cash flow, and as soon as Nathan River Resources increases its cash flow to sustainable levels and the dividends are greater, obviously, than our coupon on our debt, we would then convert into equity, which is the logical thing to do. So we should be able to, really have significant cash flows for the company going forward.
Thank you for that. Looking to the next few months, what will be the next key pieces of information we should be looking out for?
Okay, so I think there's some technical data that hopefully will come forth in the next month or two. Post that, we're obviously working, as we mentioned previously, to convert our own non-binding offtake into a binding offtake, and obviously those discussions and work around those discussions continue in earnest. That'll take a few months as well. But sometime between now and the end of the year, obviously, we'll hopefully conclude those and complete the TEO on the 1st of December, which is on track to deliver. Post that, we've obviously got the banking feasibility study, which we need to do. And that is obviously a significant fundraise again. And we will be targeting a debt structure or a secured debt structure for that outcome. So again, trying to avoid any further dilution.
Thank you, Adam. So that was Adam Habib of Amur Minerals. Exciting and busy times ahead for Amur as they keep developing their nickel project, but now start to get some cash flow coming out of this enormous iron ore project in northern Australia. Amur Minerals trades on the AIM market in London, a market capitalization of around £20 million sterling. That's it from Blytheway Business News. Thank you for watching.